Now let's move on to the next item on our Thanksgiving/investment menu, potatoes, likely of the mashed variety. What are the potatoes of your portfolio? I say U.S. small caps. And while the phrase small potatoes usually denotes something of little consequence, the historical returns of small cap stocks are, well, spudtacular. Anyway, since 1926, U.S. small cap stocks have returned 12.1% a year, so about 2% more a year than large caps. Best year, 143%.
Wow.
Worst year, down 58%. Now, this Morningstar target date report didn't break out small caps specifically. Instead, they grouped small caps and mid caps together, what many people call SMID.
SMID.
And there you go, right. But by looking at the allocations of some of the biggest target date funds, I could see that roughly speaking, for most of these funds, they have about when you look at the SMID category, a quarter of it is actually small. So again, looking at the broad category of target date funds and what some of the biggest firms think how you should invest, they have about 18 to 19% in SMIDs, which means about 5% in small caps. And that's just 5% of your stock allocation. And I think that's way, way too small. I think generally speaking, especially if you are a moderate to more aggressive investor, it's perfectly fine to have at least 20% of your stock allocation in small caps and maybe as much as your large cap allocation.
Oh, okay.
Yeah. And now when I talk potatoes in your portfolio, I'm talking about the standard white variety. But I know there are some people who like the sweet potato mush with the marshmallows on top for Thanksgiving.
Not this girl, but all right, let's talk about it.
So when it comes to your portfolio, the sweet potato mush could be microcaps. So those are the smallest of the small. We're talking companies that are worth $250 million, maybe up to $500 million. When you look at the long span of history, they actually have performed the best of any asset class, like 14% a year. The problem is they're crazy, crazy volatile. And also, because they're so small, they can often be illiquid, which makes them difficult to buy. In fact, if you look at some of the microcap index funds, and there are only a few, they have trouble matching the index because it's difficult to buy and sell some of the stocks that are actually in the index. In my model portfolios in early retirement, only those who are more than 10 years from retirement have an explicit allocation to microcaps. For those who are closer to retirement, I don't have that specific allocation because they're so volatile. So you don't need them, just like you don't need the sweet potato whatever, or as some people call it, yams.
I'm not gonna miss yams.
You're not gonna miss the microcaps.
No.
Okay.
All right. So I got turkey. I got some white mashed potatoes.
Right.
What's next?
So I mentioned the mid caps.
Okay.
So I'm going to actually give a specific allocation to mid caps, and I'm going to say it's the stuffing.
I do love stuffing.
Or the dressing, depending on where you live. Generally speaking, folks in the north, it's stuffing. Folks in the south, it's dressing. And I chose mid caps to be the stuffing because just like stuffing is something that people usually forget about during the non-holiday time of the year, people don't usually think of mid caps. It's like the ignored asset category, especially when you're looking at size of companies. But when
stuffing's so good.
And stuffing is really good.
So good.
So if you look at the long-term history, like since 1926, mid caps perform like just about right in the middle between large and small. But there are long periods when mid caps outperform both. For example, since 1993, mid caps have outperformed large caps and small caps. So it's not something to ignore in your portfolio. I think you could start, again, the target date report has an allocation of about 15% of your stock allocation. I think you could easily bump that up to 20, 25% as how much you should own in mid caps.